recording. Okay, cool. All right. So the way I would do my weekly YouTube videos is basically I would just go ahead and start off analyzing the market, which is SPY basically. And the reason why I always analyze SPY, I should share my screen, right? My bad. There we go. Okay. Um, yeah. So we analyze the market because it's kind of like all the stocks, for the most part, are going to follow what the market does. So if you know what kind of technical structure the market's in, it's going to help you when you make your trades and even your investment decisions. It'll help you make better decisions. For trading, you're going to be like on the right side of the current trend, of the current structure. And investing, it'll help you kind of like determine, should I buy more stocks now? Is it looking like we might continue moving higher? Does it look like we're going to pull back? If we pull back, what level could it pull back to? I'm going to buy more stocks there. If it doesn't pull back, what I'm going to do? So it kind of helps kind of just give you like a roadmap of like what to do. That's why I always start off analyzing SPY. And so usually the first thing I do when I analyze SPY is I put on this indicator. I think I talk about it a lot. It's VWAP, which is anchored to the beginning of each quarter. And all the indicators I use are in TradingView, so they're all free for the most part. I'm pretty sure all the indicators I use are free on here if you search them up. So I think this one's called, VWAP Auto Anchored. And if you just go to settings on SPY, you can anchor that to, you can anchor it to a bunch of different periods, but I found that anchoring it to the beginning of each quarter for index funds only, so like SPY, QQQ, which is like NASDAQ, S&P 500, Dow Jones, because they rebalance every quarter. And so I just found from other YouTubers I follow and from my own experience that tends to give really nice like technical like analysis using that. So like for example, you can also manually plot VWAP on TradingView on this button here, this anchored VWAP, and you can pick whatever anchor point you want. But like for example, if I go to like maybe January 1st, which is the beginning of the year, like the first quarter of the year, and I'll anchor it, it kind of gives like a good idea of like basically it's so easy to read. It's just when price is trading above VWAP, basically like it's in a bullish structure or like buyers in control, which basically what that means is like every time price gets close to VWAP, institutions will kind of look at that as like a fair market value place and they'll put their orders there. It's like they'll support it. So price will come down to it, they'll buy it up, come down and buy it up until it doesn't. And then we say sellers are in control or it's in a bearish structure, which just means like, well, VWAP price went down to VWAP, but there were no buyers there, or if there were, sellers were overwhelming them. Therefore, there's more selling demand than buying demand. And basically, a big tell of this drop here was when it closed below and like it looked like buyers were trying to like, buy it up here and bring price above VWAP again. They just couldn't. It's just price had opened up here. There was a wick up here, sold down. Price opened up here, wick up here, sold down. Price opened up here, wick here, sold down. Just continuously. So that was like kind of like, these are ways you can kind of get tells in the market, like in the short term. Like, okay, if you were seeing this here, maybe as an investor, you'd be like, okay, I think I'm going to hold off buying. I think I can get better prices than right now. And if you're a trader, you can say, okay, if I'm in any long positions right now, I should close them out or reduce the exposure. Or even if you really wanted to, you could short too, which is really, shorting is really, really difficult, but which I don't really do it that much. Every time I tried it, didn't really work out. But if you wanted to, you could also short there too. So with that being said, the only thing is that we just hit a new quarter on July 1st. And so usually it takes about a week before you can really start analyzing with this line. So, technically right now we're above it, but I can't really use it until maybe like next week when this line kind of gets drawn out and they start testing it. What I mean by that is like back here on April 1st, that was another new quarter. this was like, yeah, technically it's below it and everything, but really when you start getting like price interacting with it, like over here, which is about a week after it's plotted, that's kind of when you can start using it to analyze. And same thing back in April, buyers are like this huge candle, bought it up above it. They held it here, little fake out here, but they brought it back up. And then since then, basically I've been bullish in the short term because price just never even got close to it. So all this time we saw a dip here or dip here, I was biased towards the long side. So just that indicator alone should help you so much with your technical analysis. Because now if we're saying here in this area, SPY is in a bullish structure, all the trades I should be doing should be bullish biased. And, you know, and I'm going to be expecting, like when I sell a cash secured put at CSP, like I'm going to be bit more aggressive with it so I can get assigned, like when I was selling CSPs here, I was being really conservative because the price can just keep going lower and I don't want to be caught bad holding. And if I do get assigned, I don't want all my capital being assigned. I want to have more dry powder so I can get assigned again and bring my cost basis down if it happens, But when it's in a bullish structure, it's different, like the chances of you getting assigned and price moving lower for a long time is a lot lower. So you can be a bit more aggressive, expecting that like in a week or two, prices should rebound to your purchase price and then higher from there too. So that's why I think this indicator is super important. I also anchor to the beginning of each year automatically. And I found that for the indexes and for individual stocks, that's actually also another really good like technical indicator. So like for NVIDIA, I had such a good example of this last year. Like 2024, when I anchored it to January 1st, 2020. I wish I knew about this back in 2024. But like if I anchor the VWAP line to the beginning of the year in 2024 on NVIDIA's chart, and 2024 lasted until right here. This whole year is 2024. Look at how it just signaled like such a good buying point for NVIDIA at both of these times throughout the year. Like if you're an investor and you saw that, yeah, I mean, I would have been a buyer down here and been very aggressive with it, So those are two kind of really good indicators I think are good to have. AVWAP anchor to the quarter, AVWAP anchored to the beginning of each year, and they're both free on TradingView. And I'll go back to SPY and we can talk more about other things I look at. Are there any questions so far? Or is that pretty clear? And if you have questions, you can always just unmute and just stop me. I have no problem with that. All right, cool. So the next thing now is I think the markets are kind of overextended a little bit, and I use that like very lightly because like you never really know. Like this could just keep going, right? Like it looks overextended where like all these green candles stacked up in a row. But the truth is like it could look overextended for a long time before anything really happens. But something eventually will happen, right? So you just want to be kind of prepared for that. I think like this is a good example, right? Like you have this kind of looks like what we have now, right? Just green candles like in like a week in a row. And over here you could be like, well, this looks over. I'm going to short here. I'm going to sell my stocks or whatever, and then you're going to miss out on this rally. And the thing is, like, when the market pulls back, it doesn't just happen usually it doesn't just happen where the next day just drops straight down, It's going to be like, you're going to see signs, because there's going to be institutions who are like trying to support it and keep buying it up. But eventually there's going to be less buyers and more sellers, right? And you're going to see that it's like a ship, like on a cruise through the ocean. When they turn the ship, it takes a long time. It takes a lot of effort to go ahead and change course, So it's kind of the same thing when you look at it in stocks. So it's like you're going to see like a red candle, then a gap down, and then this gap down takes away the gains from basically all these days here. At that point, you can be like, okay, this could be the bottom here. I'm not sure, but like I can reduce my exposure. That's when he's not over here. This is one candle, the next day it's green candle, you know, and it keeps going up. Like that's not, it's like you see a down movement and then you see like a long wick. If you're not familiar about wicks, basically the candle is good because it shows you intraday movement. So the way the candle works is like the this the opening price is going to be where the candle body is at the top when it's red or bottom when it's green. And the way it looks like is like this was the open price here. I'm gonna turn off anchor. That means the wick means that price went up throughout the day and then went back down to the bottom wick and then closed here. That's kind of what the candle wick tells you. So on the green candle, it's the opposite. Price opened up here and closed at the top. Like there's no retracement down from either side. It's a full body, and it's like considered very bullish. Because when you think about it, price opened up and the whole day institutions were just buying. Whatever selling came in, it wasn't even enough to like retrace any buying that happened, you know. So using that will help you with your price action. You know, if we gap down, buyers tried like bringing the price back up and it got knocked down by sellers, even below the opening price of that trading day. So buyers couldn't even hold their position. They bought it at 20 bucks and now their position is worth like 18. You know, institutions don't want that. You know, they want to make money. So it just kind of shows you how much effort there is in changing this course, you know. So when you start seeing stuff like that, you can start like inching out of positions, put your investor hat on and be like, okay, we might see like a 5-10% dip. This is good. I can buy the stocks that I'm like wanting to FOMO in, you know, I wanted to buy more shares of, and you can start getting ready for that. And I believe I also drew lines at every all-time highs on this chart, because every time we make all-time highs, the market tends to pull back. Sometimes a little bit, sometimes a lot. But I drew all these all-time highs since 2009. And this was 2008 top. We had the great financial crisis. Markets go all the way up, make all-time highs. And this is on the weekly candle. So these H candles a week, not one day. So, you know, we make the all-time highs and eventually this pulls back. You know, this pulls back about 5%. You know, and on these types of pullbacks, all-time highs, those are times to really like get long. You can be aggressive here. There is, of course, a chance, as always, that you're going to be wrong and lose money. But when you look at the history, statistically, when you make an all-time high it tends to continue very strongly. So when you see that dip that we're probably going to get very soon, I don't know when, but it will happen the next, like at least in the next month for sure. Just get ready for that. You know, save some dry powder so you can, if you want to sell some puts, you can take advantage of the high IV, get good premium. If you want to buy stocks, you can like identify what stocks you want to buy. Here's another all-time highs that we had in 2015 and 16. Right, we make the all-time highs, and maybe like a few weeks later, market drops about again 5%. Hit the all-time highs here. We kind of make a new, this is one instance where like a new all-time high resulted in another big crash. But this was because the federal government decided to raise interest rates. So, you know, that was a bigger crash. So that's one. New all-time highs here, you know, again, 5% dip. This was COVID, another like, you know, economic scenario. So basically when there's no economic scenario, your risk of like a deeper pullback is pretty rare. But of course it could always happen. New all-time highs after COVID drop, you know, this one dropped a bit more, about 10%. So like you get the idea basically. Even here in the bear market 2022, we made an all-time high and eventually we did drop 6%. So, you know, based off that, eventually we're going to see some kind of drop of 5% probably. I don't know where it's going to be, but just expect that. And so the next question would be, okay, we're going to get a dip. Where could it dip down to? And just based off pure price action, or I'm not using any indicators right now. These are just looking at price, which is very like important for technical analysis. You don't want indicators telling you anything that you can't tell from the chart itself without anything on it. So just based off price levels, obviously one price is going to fall down to is the all-time highs, right? It's going to come back and test it. If it breaks below all-time highs, you want to look for these swing high levels, like over here and over here, because these are points where institutions decided to sell. So they were like, we want to sell here, and there was enough sellers to bring price down. So that tells you that at that price level, there's a lot of interest, whether it's buying or selling. And once we break above that selling level, it becomes now a buy level or support level, right? So the next level would be down here at SPY 605. If we break that, maybe down here to 595, and if we take the price from here, that would be about a 5% dip. If price continues to move up a little bit more, that it sounds about right, like historically, statistically. So that's what I'm expecting. And another way to help you with that is, of course, the moving averages, which every person should have them on their chart, in my opinion. Usually it's the 50-day, the 100-day, the 150, and the 200. And these are also good levels for investment. Let's just say like you're still learning how to like look at price and drawing those levels. The moving averages will really help you kind of find those levels yourself too. So the market found support the 100-day moving average. It found support the 150-day moving average here. We broke out, tested the 200-day moving average. So, but more importantly, with the moving averages, it kind of really tells you long-term trends. So short-term trends, you use AVWAP-Q, right? Long-term trends, you use the moving averages. And specifically, you're using the 50-day and the 150-day. And I have an article on this in Market Manual that talks about how to identify long-term and downtrends and uptrends using these two moving averages. But the idea is like when the 50 is above the 150 and they're both crossing up like 10 degrees or more, and you can measure the degrees through somewhere here on TradingView. There we go. Trend angle. Just kind of draw when you start seeing like a slope up and you see like about 10 degrees. That kind of just tells you like, okay, they're curling up enough where you can validate that this is a new uptrend, right? So 50 above the 150 is sloping up 10 degrees. No matter what dips happen, just buy those dips because most likely, statistically, we're in a long-term uptrend and we have been till this point here in April of 2025. And although that was near the bottom, that was a reason why in my daily analysis, I always had like neutral in the long term, just because like you never know, right? Price could just fail and continue down. But the key here is that the 150-day never slope down more than 10 degrees. Like if I take this point here and I pick like the steepest point, maybe something like this, it was like around 5 degrees or so. So that never fully meant that we're entering a long-term downtrend. So I was kind of waiting for that to happen, and it never did. And price broke above the 150-day, the 200-day, and then now we're sloping back above. Now I feel like there's like 100% chance that we're gonna see another leg up in a long-term uptrend. Maybe not 100, like 99% chance. That might sound like naive to say that, given all the economics out there. But a lot of legendary investors like Peter Lynch and Warren Buffett will always say like, if you spend 15 minutes reading about like our economy, global economy, you just wasted about 10 minutes of your time because no one can predict what the economy is going to do. And that's not really like your job. Your job is to buy and hold good companies in the long term to try and grow your wealth. And if you're trading, your job is to look at the technicals to follow what institutions are doing, because they have all of the information. So based off this, hopefully you guys have a good idea of what the market's going to do in the next few weeks. We're at all-time highs. We're probably going to see some kind of pullback soon. It's not going to happen right away. You're going to see signs. You're going to see like maybe a red candle here, a green candle, like kind of just like a slowly churning over of it. And if there are some stocks that you want to buy, start jotting down what those are, what price levels you want to buy them at. Feel free to use a valuation database here to kind of see what the fair value is. If there's some stocks that are near this fair value, you can try to like pick those. Otherwise, like if you want, like personally, I want to buy more Broadcom. I wish I bought more like a 200 level, even though it's still gonna probably be overvalued, even if the market drops. But it's something I like want to look at. If the market drops, how far down will Broadcom go? Maybe if it can get down to the 50-day moving average or something, maybe I'll be interested. But yeah, as far as trading goes, have some capital ready. Have some capital ready for if you want to sell cash secured puts. You're going to get really good premium. You're going to get really good strike prices. You should take advantage of that. So make sure you have some capital open for that. I don't recommend shorting, but if you really wanted to, you could buy like VIX calls. They're really cheap right now because VIX is like super low. So you can get like a couple of VIX calls for like $200 to $400. And then if the market drops at 5%, it'd probably double in value. So yeah, I'm just gonna stop right here and pause. If anyone has like questions about anything that I mentioned or about like the market, or if you want to share any thoughts you have about what you think the market might do, or like any news you want to share, you can go ahead. All right, cool. If not, then I'm just gonna go over my trades and kind of explain like what I've been doing. I know maybe some of you guys have questions about like CSP CCs, like why I pick the strikes I do, like like I got called away on Google. Maybe a question would be like, well, if you got assigned at 170, like why did you sell at 172.50 call? Why not just hold it and sell now at like 180? Those would be like valid questions. So I'll go over and look at my list here. So NVIDIA, I have been trading for a while. It's a really good stock to trade because all this time here, basically from July 2024 until like this earnings call here in May of this year, the fair value has been consistently like around 130, 135 all this time here. So it was really nice to sell puts because price was always just hovering around that fair value of 135. Until DeepSeek, basically, until DeepSeek happened right here, I had some puts at like 140, 135, and like 120, and I ended up closing out most of them. And it wasn't because of DeepSeek, it was because around this time the market was starting to show signs of weakness. So this was like end of January 2025. End of January 2025. Yeah, right here. You started seeing just like really choppy price action on really low volume. And some of the people I was following on YouTube were also starting to get a little bit bearish because of these tariff talks. And even here, like, I remember like Trump would tweet about tariffs like on Mexico and Canada, and they would pause it. Like they would announce it, market would drop, they would pause it, it would go up. And during his campaign, he was talking about like implementing tariffs. So when I started seeing like this action, and then I started seeing like the market break down, I decided to cut loss on some of my trades. And not because I was like scared, it was because I wanted to free up capital to get assigned at a lower price. So I left one contract of NVIDIA at 120, and I've been holding that basically ever since DeepSeek, I believe. Maybe even after DeepSeek, something like that. It was somewhere around here. I got assigned 120, I just held it. I sold covered calls on it when the market was going down until I couldn't because it dropped too low. But one really important thing to know is that when you do these cash secured put trades is you really want to do it on stocks that are like really good fundamentally, where like you have no doubt in your mind that eventually, whether it's a couple weeks, a month, a year, price is going to recover. That's what helps you manage your emotions when you get assigned. and take assignment. I knew like NVIDIA is going to come back. Their revenue kept growing, their earnings kept growing. No matter what news they were talking about DeepSeek or not, like I knew that based off their fundamentals, I was doing every quarter, right? I post evaluations every quarter on here. So I pay attention to their debt. I pay attention to their free cash flow, their operating cash flow. Are they increasing it? Is it increasing every time? Are they reducing their debt too at the same time? How are those ratios looking? How is their PEG ratio? How is their PE ratio? Like, are things improving despite price going down? And so I was seeing that with NVIDIA it was, so that just gave me more confidence. Like eventually the fair valuation kept staying at 135, like consistently. That means like I really think the price will recover, and it did. And I haven't sold any covered calls recently because I don't want to. It's that 160 that's all-time highs. Like I just want to keep holding the stock because in the end, the only downside of covered calls is that you miss out on more gains, right? So I would really be upset if I got called away at 150 and then end of the year NVIDIA's like at 200, So as of right now, I have 100 shares of NVIDIA at 120 and I don't plan on selling covered calls on that anytime soon. The one I did got called away on was Google. And Google was kind of similar. I sold puts on it as the market was dropping at the 200-day moving average, which was around 170 at this time. It was 175, then I think I rolled it down to 170, and I took assignment. And same thing with Google. It's Google, right? Like I knew eventually the stock was going to come back. It had good fundamentals. So in both of those scenarios, and so in NVIDIA's case, I sold puts around their fair value. That's how I picked my strike. And I picked my strike at the fair value because that's where I'd want to buy it. Every time I sell a put, I'm always thinking in my head, like, I'm assuming I'm going to take assignment on it, right? So that's how I do it. And to some people, it can come off really conservative, and that's fine, like, there's no right or wrong. That's my personality, and that's how I can sleep at night, knowing that I'm not worrying about if price is going to drop. If the price drops, whatever, I picked a good strike price, I'm willing to get assigned. If I hold those shares in like 6 months, I'm probably going to make a good killing off of it. So in Google's case, I selected a strike at the moving averages, and I held it. And why I sold the covered call so aggressively was because I sold 2 more puts on GOOG, the other Google stock, at 170 as well, and I got assigned on both of those. So I was holding 300 shares of Google, and I felt like that was taking up too much of my capital, especially with the market being overextended. I want to free up cash to sell more puts and get assigned on other stocks before the next leg up. So I sold a really aggressive call because this is like when Google dropped on June 20th, and I think it was like down here at 168. So I just sold a call basically at the 200-day moving average, which was around like 170 to 250 at this time. I think I sold the call at 170 at first, and I was like, why am I getting called away at my cost basis? That's stupid. I should at least get some money out of it. So I closed it and opened a new one on 170 to 250, and because I wanted to get called away. I knew Google was for sure going to be above 170 to 250 in that week, so I didn't want any kind of guessing there. So that's why I picked it there. That's why I let it get called away. But for GOOG, I have 2 puts, same thing at 170, average cost basis. I got assigned at. I sold 1 call only at 180, expiring in 2 weeks, which I might get called away at this point, which is fine because I have another 100 shares of Google that I'm going to, same thing as NVIDIA, I'm going to hold it because I think in the long run, it's eventually going to hit back to this all-time highs at 208. And 170 to 208 is a lot better than 170 to 180 for some premium. So that's NVIDIA, that's Google. I have a position at APP, App11, and the premiums on this stock are really good because it's so volatile. And I sold a put on this stock because I ran a valuation analysis on it, and I saw that like every quarter they were like really increasing revenue and they had really low debt. And I saw a lot of institutional involvement. Like when you look at volume, as like the move was going up, like volume was like increasing on each up move, like increasing, especially here. I don't know like what happened here exactly, but like that's huge volume, like with stacked green candles in a row. That just like, if you don't know, like that is institutions buying, right? Because might look at this without volume, be like, oh, this is overextended. We're gonna see like a pullback. It's gonna drop, you know. But when you see big volume like that, how much volume was that? Like 7, 8 million shares traded each day consistently. That is like, okay, that's institutions buying. They're not gonna let this stock ever go back down to their purchase price down here at 88, you know. So I saw institutional interest, I saw good fundamentals, and there was really good premium, and it was heading down to a really strong support level, which is AVWAP-Y, which is, like I mentioned in the beginning of this call, VWAP anchored to the beginning of each year. And this is above my fair value. I had my fair value APP at around 300, but I was willing to pay a premium to own it because of the technicals, you know. It was this levels around all these big moving averages. If I put the 100-day moving average too, right? So we have like AVWAP-Y, 100-day, 150-day moving average. There should be a lot of buyers here, right? So I got a sign down here at 325. I did not sell it. I've been holding it. You know, maybe I want to run it by my bathroom or something. I don't know. But like, I'm getting a bit greedy with it because I know that there's potential for the stock to head higher, like maybe to 400. Now, in terms of trading, one negative about my mindset right now is like, because I'm being a bit more greedy with it, I'm assuming more risk, right? I could have easily sold a covered call here at 350, made 25 bucks a share and collected like a grand in premium and just call it a day, right? That is fine. You know, maybe I should have done that. I don't know, but because of the market structure, we're all-time highs. We might pull back, continue the all-time high movement. Because of that, and APPs and talks of being included in the S&P 500 next quarter, like I still think, and most importantly, this technical structure is still holding, even though we broke below the 50-day moving average. It's still holding the 150 and the 100 and EVWAP-Y. So I'm assuming more risk to get more gain from this. You know, if you were a newer trader, I wouldn't recommend doing that. I would recommend, you know, taking the gains and walking away. But, you know, I've been trading for a few years. I have some good profits behind me. I can assume some risk for some more gain here. But that's APP. That's why I chose the strike I did. It was based off AVWAP-Y. Good fundamentals. And, you know, what they say, right? Buy low, sell high. So you want to buy a support, which I did, and hopefully sell at the next leg up. And then I have two more positions I'll talk about. One's Uber, and Uber was actually following. Let me open up my other screen. Uber was following something called the Wyckoff method, which I trade once in a while. Let me go to the current time. This chart might look messy. Okay. Which I also posted an article about in our Discord under Market Manual. It's called the Wyckoff methodology. And actually, I don't think you guys can see it. You guys can. Okay, good. So Wyckoff basically, just really quick, institutions accumulate shares. Like institutions are like Costco, right? They'll buy their goods in their warehouse for like wholesale prices and then sell to retail at retail price, right? Like that's how they operate. At least market makers do. And so they'll accumulate and distribute in these consolidation patterns. And then once they have a full inventory, they'll mark prices up as they sell to retail until they're out of stock, and then they'll restock their shelves, right? That's kind of like the basic idea of it. On the opposite side, if they think for whatever reason the demand is going down, they want to offload their shares, they will distribute it and mark prices down until they want to restock to either sell it down again, or now they think it's at a better price, they can mark it up and have some interest, because they also have to gauge how much demand there is for the shares, right? They don't want to accumulate up here and then they find out like, wait, no one wants to buy Uber at 60 bucks right now. We're going to be stuck holding these expensive shares up here. So they have to test and make sure where the demand's at. And that's why you have those like fake outs. The fake outs are not to fuck over retail, like how people think. They're actually just testing to see where the demand's at, right? So when they broke Uber down here and they saw like a lot of interest there, like I'm sure if I turn on volume, I'll probably see big volume there. Wait, why is the volume not showing up? Oh, because of this. Yeah. So this is actually around earnings too. So they brought it down, big volume on this green candle before earnings. Earnings came out good. It was bought back up. They said, okay, people are willing to buy this up when it drops below this consolidation level that we set here. And then they tested the upside too. They said, well, okay, like, are we ready now? Are we ready to mark up prices? Is there enough buying? And they push it up, and too many sellers came in, or not enough buying volume either. So it's either they don't have enough buyers, or there's too many sellers. They said, okay, it's not ready yet. Let's accumulate some more and wait for more interest to show up. And they'll just keep doing that. They'll keep testing. So fake out, fake out, fake out down here. Look how much volume there was in this fake out. So much buying. Well, and I don't want to sound like I'm some kind of like psychic, right? Like this is all hindsight. In the moment, you don't know if this is buying or selling volume until after. And according to the Wyckoff method, you're only going to know when price finally breaks out one side or the other, tests, and continues. And that finally happened here in May of this year. Price broke up, tested, and then continued above the swing high that was set here. At this point, we say all this back here was an accumulation pattern. All these fake outs to the downside were to gauge buying interest, and there was, right? So hindsight, I know that this is an accumulation structure. In the moment, no one knows. Only the market makers know. So when I saw this pattern and it broke out and it came down to test again and again, I was like, okay, like this is a clear Wyckoff trade. Like I really want to take advantage of this and participate. So I started buying shares at like $83, 84, and then 85 to get a cost basis of around 85 bucks a share, with my stop loss below like a wick basically, when they were testing to see like if buyers will support this breakout, and they did. So I put a stop loss at the 80 bucks level at that wick, and I've been holding it since. And one more important thing why I was so convicted with Uber was because of the valuation. I added to the valuation database because I saw like they were kept increasing their revenue, increasing their free cash flow, and paying down their debt, which is very impressive. And I saw that their fair value was around 100 bucks a share. So it's undervalued at all-time highs of the Wyckoff breakout. I said fundamentals and technicals align. I'm going to go for it. And then same thing, I'm not going to sell covered calls on this trade because I don't want to get called away too early. I sold one covered call earlier and I closed it. I was like, you know what? Because I realized like emotionally, I was like, if I get called away before 100, I'm going to be really upset. So I said, I'm not going to do that. And again, if you have any questions, just stop me. You know, I want to just, I know this could be a lot. So yeah. Last position I had was HIMS. HIMS is another impressive stock, which I really didn't take seriously for a long time. But after looking at their fundamentals every quarter, I was seeing the same thing, like low debt, high cash flow. They partnered with Novo Nordisk, which didn't go through, but still, like they had interest from Novo Nordisk to partner. Like that's really impressive that a big company would put trust to partner with such a growing company like that. And I saw that their fair value was around like 40, like $38 to $40 ish. And I noticed that up here, and I couldn't sell puts because like you have to be disciplined, right? And I was like, I couldn't sell puts knowing that the fair value was down here, and I didn't want to get assigned and get stuck back holding. So it was really hard, but I had to really stay patient, and eventually the price did drop. And I got really happy because now I'm like, okay, I can start selling puts and get assigned at like really good prices. So I bought manually 100 shares at 43, I think 43.40, because from this price action here, like I just it's such a like it won't drop lower. Like HIMS, there's so much buying interest or whatever it is, like it just won't drop. So I said, you know what? Let me just buy 100 shares now. Even though that's like a small position, I'd want more, but let me just do it now. So that way, like if the stock runs up, I'm like participating in it. And it's only 40, like it was like, $43 a share. It's not like a huge company, a huge stock. So it's easy for me to kind of do that. Um, but HIMS is a really good one if anyone wants to practice wheeling. Because it's like a sub $50 stock. It has good fundamentals. It has good technicals. I mean, even when the tariff drop happened, it still stayed above its 200-day moving average, where SPY dropped way below their 200-day moving average, right? And HIMS that whole time stayed above the 200-day. That's like a lot of strength there. So if there was a stock that you were considering wheeling or wanting to sell cash secured puts, or maybe you want to buy 100 shares, sell covered calls on it, this would be a good candidate in my opinion. So yeah. So next week I have two puts at 43 and 40. And if you're wondering why I'm still choosing like conservative stocks is because strike prices, because I think the market's going to pull back. We've been at an all-time high. Historically, market pulls back after all-time highs. So therefore, I don't want to get assigned too early. I'm going to keep the strikes down and hopefully get assigned at that good price. So we'll see what happens. And those are all my trades. That's quite a lot of trades I have now. But I hope that kind of helped you understand like what strikes I pick, why I'm picking the stocks I am to trade, and what kind of criteria I'll look for when I pick a stock to wheel. So good fundamentals, good technicals. Um, so yeah, do you have a question? I think I heard someone talk. That's a good question, man. So P/E ratios I don't look at as much as a PEG ratio, but the two things I look at is P/E ratio, like you mentioned, the industry average. That's a good one. So look at the PE ratio for the industry average. And then number two, I would look at if the PE ratio is less than their 5-year historical. And I think you can do that on Seeking Alpha. If you go on Seeking Alpha, they'll show you the 5-year PE ratio historically. But more importantly, I would look at the PEG ratio. And in my valuation database, that's why I list them and those stocks there. I'll show like the PEG I ratio, which is a PEG ratio divided by their industry PEG ratio. And why is it better than P ratio? Is because it factors in their future growth. Because sometimes like Nvidia's PE was like so high, but it kept going up like so much, and people were confused. But if you look at their PEG ratio, the PEG ratio was like 1, like that whole time, which means that the price is matching with the growth prospect. PEG ratio is your PE ratio divided by the growth forecast. So basically like price per earnings, and then you also factor in their earnings growth. I maybe you could look at it that way, momentum. I guess you could look at it that way, yeah. I see it more as acceleration, yeah. Yeah. Peter Lynch made the PEG ratio really popular. That's what he would look at. He would see like in his terms, the PEG ratio was like 1 or less. It's considered like a good value, and if it's above 1, that means that the current price is still, despite their earnings growth projection, it was still like at a premium currently. But yeah, that was a good question. Yep. Well, it's been almost an hour, and I pretty much went over everything I did, and I think I rambled enough. If you guys have no more questions, um, I'll maybe give one more chance if anybody else has any more questions. Yeah, yeah, I'm recording this right now on using my recording software. So I know it'll pick up my voice. I'm not sure if it'll pick up everyone's voices here, but it's for sure recorded and what I'm saying is recorded. I could post it on YouTube. Yeah, I could do that for you guys. So I'll post it on YouTube. I was gonna share it in Discord, but I'll post it on YouTube and share the link there in Discord. Yep, no problem, guys. No problem. But yeah, thanks for joining. I know it's like the morning after July 4th, so I appreciate you taking some time to just kind of chat with me about the market, ask some good questions, and yeah, I'm always in Discord. So if you ever have questions, you can always like tag me. I'll be happy to like hop in a call, or if you want to just chat about something, ask me a question, we can always do that. You know, our community is still pretty small, so it's like manageable for me to kind of like talk to everybody. So yeah, take advantage. I love helping out. So yeah, thanks again, and have a good weekend.